Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
I would say this Wednesday exhibit C is a little up in the air on crude supply because of the possibility of just a multi-week, multi-month stalemate between Iran and the United States on the Straits of Hormuz. The U.S. strategy is to try to keep the South Channel, it's called. It's a channel along Oman as compared to, I guess, the North Channel, which is the channel along Iran, to keep the South Channel open. I don't know whether that's feasible from a military point of view. If it's not, I just think that oil pricing will be closer to 80 than closer to 65. I don't see 90 or 100 in this. I think plenty of oil is getting around the strait by pipe and piped up to the Mediterranean and over to the Red Sea. And I think the world oil business has learned that it can probably handle shipments through the Straits of Hormuz bordering on no shipments. The price last Thursday was 73. That obviously is going to be much higher now. I think what will happen is there'll just be more backwardation. In other words, the current price will be quite a lot higher than the 27 price. I mean, last Thursday there was only $3 backwardation. I think now there's probably $10 of backwardation. I think you see that producers are focused on the 27 price. They're happy to have extra revenue from higher current prices, but they're making decisions based on the 27 price. So there hasn't been any big increase in rigs drilling or other activity. As far as Exhibit A goes, we are running about even with last year in terms of the deficit through May. There needs to be something bipartisan, political to happen here. I think the stimulus for it will be problems in the U.S. sovereign credit market. Hard to predict when that will happen from a timing point of view, but almost inevitable to provide some discipline on spending. Main focus, I think, will be healthcare, because that's where the money is. Do too much about interest. Really can't do too much about defense, so it'll focus in on healthcare. There will be some legislation introduced on Social Security, but those will be minor fixes, and I don't think that there's any political consensus at all to interfere with the amount of Social Security payments being made. And with that, I think we're only about 3 or 4 minutes into our 30 minutes. So despite all the headlines, I think that's a pretty good summary of Exhibits A, B, and C. So we can go over to Mike and Jason. One thing I like to do with this Wednesday call is focus on anywhere in the 20 pages we think we see some value. And we have a pretty high stock market now, but the things we're interested in have been, some of them have been, pretty restrained, pretty modest increases year to date. But let's go to Mike and Jason, and then on this value idea, we can spend some time on it this week, or we can focus on it next week. So Mike and Jason, over to the two of you.
Okay, well, we generally cover the big tech companies, and so the question is, where is their value on these pages? A couple of things are happening at the same time. You have skyrocketing prices of some of the semiconductors and some of the semiconductor equipment companies, because we are now in what is pretty well understood to be a major shortage of not only logic semiconductors, but also memory. And if you remember, last week we had the Korean memory company SK Hynix did a US IPO, raised $26.5 billion. It was 7x oversubscribed. There's fairly clearly plenty of demand both for memory and for logic. JP Morgan has raised their CapEx growth forecast. And yet, some of these companies that operate this infrastructure are trading at prices that are pretty reasonable. I talk about Amazon, Microsoft, and Alphabet in particular because there are hyperscalers. And while the cash flow is relatively low, remember that it's optional spending, Microsoft's trading closer to 20 times earnings, Google closer to 30, and Amazon similarly closer to 30. So, sometimes value is hiding in plain sight. And if you can get comfortable with the way that these businesses are operating and the essential bet that they're making, and understand the cost of replacing these data centers is very high. So the assets they have in the ground are actually quite valuable. There may be some value sitting right there on page one. Would you agree with that, or you want to throw a wet blanket on it?
I agree with it. And one of the things we've been talking about lately is what happens to OpenAI with all the issues they're dealing with if they can't go through with their leasing commitments on data centers. And the discussion is always like, well, there's so much demand for tokens, someone else will pick up that capacity. And that just leads me to believe like where the value accrues is the infrastructure providing the tokens. And I've long believed that the data is value, not necessarily the model. And it's looking more and more like the models become a commodity today. So I completely agree. I know Hunt's not as excited about Amazon, but in my view, they're really strongly positioned to be the infrastructure provider of tokens. Google obviously is as well with their own model, but Amazon's the one I think that gets overlooked. Their Trainium chips are near the front of the pack. They're probably maybe just behind Google and Nvidia, but they're overlooked because they don't have their own model. And the history of Amazon is they will partner with a company providing a new software product. They'll learn the users of it. They'll learn how to host that tool, and then they'll replicate it themselves. And I just, from hearing what Andy Jassy and the CTO or the president of AWS division talk about it, they're going to do this with model providing, with LLM services as well. So I think there's a lot of value there that they're going to be another player in a low cost token provider for maybe the open source models.
Jason, what about Oracle? Go to page 2. They made this big commitment to OpenAI, a 52-week low. They've added debt. They're probably pretty challenged on their historic business. Certainly, there's historic Oracle business to those system software businesses, enterprise software, I guess you'd call it. But is it a value trap? In other words, it's cheap and it's going to get cheaper, or do you think there's some value here?
If I had to guess, I think it would get cheaper, but at some point, what's scary is the amount of debt they have. But at some point, does it become cheap enough where, like we've been talking about, someone will pick up that data center capacity, and then they're, not in such a tight spot anymore.
Right.
IBM kind of gave a signal this week where their legacy mainframe business, which they still sell, was impacted because IT budgets were focused on AI, and Oracle's not selling that old of mainframe systems, but I wonder if the same thing's happening with their legacy database software.
Yeah. Right. I think the risk with Oracle is that $110 billion of net debt. A highly leveraged business seems really good when things are on the up and up. if things get a little wobbly, you could see that equity value deteriorate very quickly.
Right.
Yeah.
Look at Charter. I mean, Charter a few years ago, it's what, $130 a share today. It was over 1,000 or near 1,000.
Yeah. Yeah. And Oracle's still committed to high capital spending. They show no indication that they're going to slow down. But when you see the return that XAI or SPX now makes from its capacity in Memphis, you think a couple of things that you guys are right on Amazon and maybe the the Azure part of Microsoft, the ramp in revenues there from the data center capacity may be really significant.
Absolutely. And you could potentially make a case that Oracle would be worth more if their OpenAI deals were canceled and they could contract that capacity on the open market.
Elsewhere. Yeah. Speaking of value, you turn to page 3, you could argue that Nvidia is a cheap stock.
We would argue that. On this page, Nvidia and then Taiwan Semiconductor, which doesn't look quite as cheap, especially since this year they're going to do $60 billion in CapEx.
Yeah, without the political risk of being in Taiwan, I think you have to say TSMC is cheap. Mm-hmm. And then memory, we have Micron on that page. Memory is always going to be cheap, right? Just because of the history.
It's always going to be cheap when the stock price is up, and it's always going to be expensive when the stock price is down.
Yeah.
Yeah. My concern for Nvidia really is the price of memory. So we've seen the headlines that the cost of a gigawatt of data centers maybe doubled this year. And the CapEx budget from the hyperscalers isn't going to go to 1.4 trillion. So are they going to order less chips? That's the question I have on my mind.
Yeah.
There's a lot of pressure to figure out how to make memory more efficient in a data center. But even with those innovations, we're going to need more memory.
Right. Meta on page 4, very controversial. I mean, they have trillions and trillions of dollars of litigation based on doing harm to our young adults and younger than younger adults. But still, incredible cash flow machine. Rate whether or not Meta is cheap. I guess it's too expensive to be cheap, I guess, is the answer.
Well, I think you have to look at how much CapEx they're spending and ask yourself, how much CapEx do they need to spend to maintain their current business? And it's fairly clear that they wouldn't need to spend $75 billion a year on CapEx in order to maintain that current business. It is also, however, true that that business is extremely well suited to a proprietary model, meaning a proprietary AI model, because they have basically an ad placement and measurement system. So they have very clear understanding of what the inputs and what the outputs are and how better to optimize that than with AI models today. And to their credit, they were really the first company that commercialized AI on a large scale back in, the 2010s, essentially. So I think it's a difficult company to be a shareholder of because you basically just have to trust in Zuck, but he's done quite well so far, oftentimes too early, but I think they're relatively well positioned.
And glasses versus iPhones, I mean, we're not going to give up our iPhones for wearing glasses, I don't think, shall we?
Not yet. I think the glasses have to be more seamless in order to get there. Maybe we haven't discovered what the next form factor is.
Netflix is kind of looks like a value trap too. It's cheap, but it gets cheap, right? I don't quite get it. I thought they made the right corporate decision not to drop out of Warner, buying Warner and loading their balance sheet with debt. But they were $100 stock now they're $73 stock. So what I thought was a good strategic move hasn't worked out too well for the stock. I guess there's the perception out there that they're losing market share.
Yes. We have a theory on that. I don't think it's worth going over today, but I think it's about the type of content that they've produced. And potentially they felt that the Paramount acquisition would give them some of the type of content that they would need in order to retain their customers. And maybe what's happening today is we're starting to see some of that bleed. Paramount's become a pretty good product, and to many people's surprise, it seems to be doing quite well.
Jason, how about healthcare news?
I don't have a lot in the way of healthcare news, but the one thing I do want to talk about is about a month ago, there was an approval for a combination therapy that it's a diagnostic along with a cancer treatment. The first one where an MRD test, which I believe we've discussed in the past, but this is a molecular test to look for traces of cancer DNA in your bloodstream. So it's the first time that they've approved a treatment to be administered based on a result from one of these molecular MRD diagnostics. So we've been following the companies that are all suppliers of MRD tests for quite a while. And this is really it's kind of the first realization that our hypothesis is accurate. So it's kind of notable because physicians will be able to detect reoccurrence of cancer at a lot earlier stage and then administer a treatment and see a positive effect on it. So pretty good news there. And not specifically the Genentech Roche bladder cancer treatment.
On Jason's watch, we're not going to consider United Healthcare as being cheap.
I think they report later this week. Frankly, I expect them to do pretty well. Last year, there was pressure on the cost of treatments, but what that enabled them to do is raise the prices proportionally on premiums this year. So I expect, we saw it in Q1, and I expect we'll see it again as a pretty good bounce back in profit margin.
Right. I think the average premium hike was going to be in the high 20s or low 30% range.
Yeah. Unsustainable.
Yeah.
Lilly has all this strength. They just keep going. They're awfully good on the weight reduction, and then they have these other medicines going along. Jelly, it never gets cheap. I mean, I guess the ranges here is like 600 to 1200, and it doesn't seem to want to go down to a more reasonable price. It's one of the dilemmas of a value investor is you miss some things that never get cheap.
Right. I think Lilly was cheap, with a higher multiple. The stock price was lower.
Right.
But
Right.
the challenge was discerning how good actually Lilly's strategic position was with its products relative to the other GLP-1s in the market.
Right.
And now it's pretty clear that having these three different options at three different price points is quite good because you can capture value at all ends.
For those of you on the call that follow investing, this was the ongoing discussion between Warren Buffett and Charlie Munger. Charlie Munger would say cheap is a good business that has good proprietary position and should be willing to pay up. And Buffett had to be weaned away from, I could buy this company for less than its working capital. So, but credit Munger's intelligence and relationship with Buffett, he finally got Buffett around. So Berkshire Hathaway would take positions in things like Coca-Cola, which wouldn't have qualified under the cheap formulation. Speaking of cheap, on page 15, Biotechs, which you have to be nervous about the two founders leaving to set up their own business. The Biotechs always seems to be cheap. They're so disciplined. They still have the roughly $15 billion that they accumulated being Pfizer's partner in COVID medicine. And they've gotten to the point, I make their free cash flow after $2 billion of R&D and $500 million of SG&A. The cash deficit of, say, 700 billion, I guess it's for euros, just about is offset by their 500 billion that they get from investing their cash. So, but that doesn't necessarily bring new businesses, So Moderna is the other COVID company, and their cash position is declining. I mean, they're down to 3 or something, but perhaps they're the ones that are going to have the medicine. Biotech will just continue to be a series of research projects. Jason, how is that an unfair comparison for BioNTech and Moderna?
I think BioNTech has a lot of positives going for them. They were more disciplined in their acquisitions with the stockpile of cash from, post-COVID. I think they both have really good prospects for potentially providing mRNA cancer therapies. And I think the first one we'll see is melanoma. Essentially, it's an prime your immune system to actually fight a tumor cell. I like BioNTech more. You're buying that potential pipeline for a lot cheaper.
How's Vertex doing with this pipeline?
So Vertex, they have the 2 kidney disease drugs. One of them has a PDUFA date coming up, and that treats a condition called IgAN nephropathy. And the other one, I forget the name of the specific condition, but this is a genetic variation of kidney disease, because there is a diagnostic for it. But most people with this form of kidney disease don't know they have that specific form because there's no treatment. So Vertex is going to have this battle where they're educating physicians that they need to provide. Now that there's a treatment, they need to start providing the diagnostic. So, and Vertex does not own the diagnostic. So it'll be interesting how they commercialize that therapy. On Jurnavix, so the non-opioid pain treatment, it got off to a very slow start. What we're seeing is physicians really, really like it. They're recommending it, but most of their patients, even though the drug is on contract with all 3 of the big PBMs, it's not on the formulary. So most patients are being denied coverage for it. So that's something they have to work out. And in the prescription data, we've seen it kind of inflect in the last, call it 2 months. So maybe those challenges are being solved, at least with one of the PBMs. What else? In their pipeline is the type 1 diabetes treatment. I really hope that sees approval. And that study was a phase 1/2 that got rolled into a phase 3. So we should see results pretty shortly, I believe. And that serves like a smaller market of type 1 diabetics. So these will be patients that have very, very severe forms of it. And some of them are already on immunosuppressants for other therapies, or they've had transplants, and they will be the ones candidates for this stem cell therapy, which we expect to be a quite expensive treatment.
All right. And then just in closing, Harrow again had, I guess, disappointing subscriptions. But what's your read on prescription trends? What's your read on Harrow now?
So it's interesting because the prescriptions volume was doing incredibly well after they were put on the CVS pharmacy formulary. The problem was they had a program where they were going to buy down patient copays to make sure that every patient could access it afford. CVS, however, priced it in a manner where when Harrow included that buy down, it was net negative revenue for a lot of the patients. So that was an error that they saw at the end of Q1 and corrected. So you could argue they should have seen that earlier. So it'll be interesting to hear management's commentary on solving that and what that cohort of CVS customers are contributing to revenue in Q2.
Right. I think what we should do next week, right? We don't spend that much time on, other than healthcare, on the companies in the back. I think we ought to sort through maybe next week, start from page 20 and see if we can identify where we see some value. The stock market on anyone's analysis is high, but I think there is value out there, and I kind of agree with both of you on Amazon and Google. I'm not sure about Microsoft. I'm a little worried about the Office product and people losing, that's per seat and having a decline there that so increases in Azure and Copilot and whatnot kind of get offset by a decline trend in the business that carried them all this way. But certainly Amazon and Google and heck, Microsoft, very, very, very good investors, long-term investors have loaded up on Microsoft. So it's not entirely clear that their Office and Windows positions are really hurt by AI. And then I love Jason's assessment of Nvidia that let the hyperscalers go up 30-40% more. There may just be amongst the hyperscalers just a lower budget to acquire chips, or less money available to acquire chips. I think that's very perceptive, Jason.
Yep.
Okie doke. Well, we have to go back to soccer, see how Argentina and England are doing. In the meantime, we'll be here 7 days from now, and by 7 days from now, we'll have a World Cup champion, because the final is in New Jersey on Sunday. But in the meantime, everyone be well and stay healthy, and thanks so much for listening. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.